I'm about to show you my step-by-step plan for building $5 million of assets without any MLMs or get-rich-quick schemes or any other huckstery stuff you might be used to seeing here on YouTube. The number one key to building wealth is to spend less than you earn. What? The key here is that you want to take the excess, the difference between what you spend and what you earn, and invest that into assets that can grow your wealth. An asset is anything that provides a current, future, or potential economic benefit. But for simplicity's sake, we'll just say that an asset is whenever you use your money to make more money. And if you keep doing this, eventually you'll acquire enough assets that generate enough money so that you don't ever have to work again. This is what's known as financial independence. And at this point, you're probably thinking, duh. But wait just a second before you click away from the video, because this next part is what most people screw up. See, the vast majority of retirement planning and wealth building focuses on something called your savings rate, the amount of money that you are saving as a percentage of your income. The problem is that if you just focus on this number and say, let's say I'm going to try and save 10%, you run the risk of actually not saving enough money and investing enough money to be able to afford the type of retirement that you truly want. The amount of money you want to spend in retirement has nothing to do with the amount of money you make right now, and therefore it's not directly related to your savings rate. Instead, we want to start with the end goal in mind. To do that, you want to ask yourself, how much money do I want to spend per year or per month when I'm done working? Now, most people have a much better idea how much their life costs them on a monthly basis instead of a yearly basis. And so we're gonna start with that. We need to answer the question, what is our desired monthly spending after tax? How much do we wanna get per month in our bank account? For me and Hannah, we'd like to have $12,500 per month in retirement. Now, we currently live on about half of this. So where did I get this number? The honest truth is that I don't know how much I truly want, but I'm really young and I have a lot of big ambitions, so why not shoot for the moon here? I feel confident that $12,500 in today's money will more than cover the ambitions that we have, so I'm starting there. Now, once you've decided on your number, the next thing you want to do is decide how you're going to achieve that amount. For me, by the time I retire, I would like to have my portfolio split roughly 50-50 between real estate and a traditional stock and bond portfolio. So that means that I need to figure out how to generate $6,250 from each. Now, I should say I'm trying to be pretty conservative here. I'm assuming that I'm not going to work at all or generate any income of any kind in retirement, which is pretty unlikely. I'm also assuming that I'm not going to get any Social Security of any kind, that it's all going to be gone. Maybe that's not as unlikely. And I'm also overestimating the amount of money that I think I'll need. That being said, let's jump over into the spreadsheet that I built for the rest of this section. For the sake of simplicity, we're just going to assume that my investments will keep pace with inflation, plus an additional percentage of growth on top of that. Hang with me and you'll see what I mean. So here's our spreadsheet, and the first thing that we want to do is kind of a crude back of the napkin phi number calculator. Now, everything that I'm about to do is based on the Trinity study, or something called the 4% rule. And this study looked at a bunch of different, what they call safe withdrawal rates. And they found that if you withdrew 4% of your starting portfolio in the first year of retirement and then adjusted for inflation after that, 4% is a safe number you can kind of plan retirement around. Now, that's kind of an overly simplistic explanation, but I'll leave links down in the description below if you want to dive deeper. This is good enough to get us in the ballpark. I'm going to go ahead and put in my birthday, which is July 28th. I'm going to put in my desired monthly spend. Obviously, I could change this number up and it would switch up these numbers here, but we're going to stick with our 12.5. 4% is that safe withdrawal rate I was just talking about. And then we also need to plan for taxes. For simplicity, I'm going to assume that all of this money is going to get taxed at 25%, which is, I think, conservative because a lot of this money will ultimately be tied up in tax deferred or tax-free accounts. But I digress. We'll use 25%. Then what it's going to do is calculate, oh, okay, well, you need $150,000 after tax per year to generate 12.5 a month, which is $200,000 pre-tax. Or if you divide this number, 200,000 by 4%, you get $5 million. Thus, we get my phi number of 5 mil. Now, keep in mind, this again is just a ballpark calc, and it doesn't yet include any of the real estate stuff that we were just talking about on the whiteboard. So I'm going to actually go a little bit more, add a few more details. Let's change this. Okay, so I've got another calculator here. First, I'm going to put in my current portfolio value. This is how much I already have in assets. We'll go ahead and just put 50 grand in here to give us a starting point. We're going to put in our 6% investment return. A few minutes ago, when I was talking about inflation and that whole not using it, we're going to assume that for the purposes of this, that we're going to get 6% per year after inflation. We're also going to just put the current rental or dividend income to the side, and then we're going to put in 50% for our long-term desired percentage of stocks and bonds, just like what we said on the whiteboard. And for the desired percentage of real estate, we'll also do 50%. The last input that we need in this calculation is the cap rate for the properties. Now, I know I'm throwing a lot of terms at you here, but cap rate just stands for capitalization rate, and it has to do with the amount of net operating income that a rental property, for example, makes compared with the amount that the property is worth, the amount that you could sell that property for on the market. We're going to assume 5%, which I think is actually a little bit low. If I was really looking for some properties, I would try to get one with a cap rate closer to 7 to 8 or 9%. But for the purposes of this, we're going to assume 5%. We're also going to assume that in retirement, I've got these rental properties paid off. I don't owe anything on these properties. So I get to keep that full 5%. Now, this calculation is going to pull all of this information up above. So we're still keeping our safe withdrawal rate at 4 for our stocks and bonds, our effective tax is at 25, and my birthday here. Then what this little bit does is it looks and says, okay, well, how much cash flow after tax do you need for the stocks and bonds to generate? Well, it's going to be 50% of this 150 up here, thus it's 75. And then how much does our real estate need to generate? Well, of course, it's going to be the same because we're keeping 50-50. So then the bottom line number that is interesting to us is this piece right here. In order to generate $75,000 after tax, assuming all of this, we need a total portfolio of stocks and bonds at $2.5 million and a total portfolio of real estate value at $2 million with a 5% cap rate. And to try to make this a bit more real, I want to actually show you what a example portfolio might look like. If we were going to do $2.5 million in stocks and bonds, $2 million for real estate, this is what one could look like. Maybe we have 3 long-term rentals with an average value of $250,000 that generate $781 each per month. Then we have a short-term rental property that's worth about $500,000 that generates $1,562 a month, and another short-term rental at $750 that generates $2,300 a month. Again, I think these numbers are fairly conservative based on everything that I've learned about real estate with this cap rate. But like I said earlier, I like to be really conservative when I'm calculating this kind of stuff for myself. Then, of course, we have our stocks and bonds, which is going to generate $6,250 a month, getting us to a grand total of the $12,500 that we're looking for. And now things are starting to feel a little bit more tangible. So I know in order to hit my FI number, I need to buy and rent these 5 properties, pay them off, of course, along the way, and then I also need to accumulate $2.5 million in stocks and bonds. If I can do that over the next couple of decades, I will be able to hit my long-term FI goal. So at this point, we know how much money we want, and we know the assets that we need in order to generate that money. The next question is, how do we get those assets? And this is where we're going to work backwards from that end goal to figure out how much we need to be investing right now, today, to make sure that we're on track. So we're going to do another back-of-the-napkin calculation, this time using the formula PMT in Excel or Google Sheets, which is just doing a behind-the-scenes compound interest calculation to determine how much money you need to be contributing on average per month in order to generate a certain return or a certain total amount at the end. The way this works is we're going to put in, again, all the same information. My birthday, for how old I am right now, how much money I'm trying to generate, the current portfolio value, the interest rate that we're using, and then I'm going to do this kind of complex calculation here in the middle to figure out how many years I have to a certain age. Then it spits out the amount I need per month. You can see here, if I wanted to hit my 5 million by age 50, I'm going to need to contribute $9,230 a month. Age 55 is $6,145. Age 60 is $4,194, and age 65 is $3,000 a month. Okay, but here's the problem. I don't make enough money to contribute that much to my investments right this moment. So what good does this do me? Well, it gives us a starting point. See, ideally, I'm going to increase my income as I get older, and I hope you will as well. So if I can control my spending right now, I can consistently increase my investment contributions as I increase my income throughout my life. Besides, this is just an average. I don't need to be contributing $3,000 a month right at this moment. Maybe I'm doing $1,000 right now and $7,000 a month in the years leading right up to retirement. That's why we have one more calculation to run. We need to forecast out what a typical increase in contributions might be. So on this next tab, I've done basically an approximation for how much money I need to contribute per month in order to hit financial independence by a certain date. So you got a few inputs up top: annual APR of 6%, current portfolio value, my birthday, and then the last date that I've updated this spreadsheet. You can see I've got some instructions over here, and if you want to download this spreadsheet and play with your own numbers, you can do that in the link in the description below. Let me explain how this works. So all these different areas here, they have a bunch of formulas in them all about calculating present value and future value and all the fancy sort of compound interest stuff. All that you really need to know is that you're going to mess with this column right here. So you can see that I've chosen to sort of optimize for hitting 5 million around age 60. And so what I did is I just started literally just typing new numbers in here and just going like, okay, well, what if I can do 500 a month this year? Type that here, and maybe next year I can do 800 a month, and maybe next year I can do 1,200 a month because I think I'm going to increase my income, etc. And I'm just playing around, and then maybe I come down here and I'm like, yeah, I'm really crushing it down here and I'm making plenty of money so I can contribute a lot per month. Maybe I, play with these, and I'm literally just changing numbers, and every time I do that, it updates this column. So what I did is I just started here and I started working backwards and just manually changed a bunch of numbers from 7,500 down to 7,000 and sort of slowly whittled them down as I went and worked backwards to a reasonable amount that I felt like I could confidently contribute this year. So you can see right now in 2022, I'm trying to contribute $500 per month to my investments. And if I can do that, then it will help me stay on track towards 5 million at age 60. Mapping it out like this with a guesstimate, it helps me realize whether I'm way off base or whether what I'm doing is realistic. It also, as a business owner, helps give me some goals that I can aim for where the business needs to be by different ages so that I can actually be saving that much per month. If I really want to stick to the spreadsheet, then by age 40, I need to be, making enough money that I can actually save or invest $6,000 a month. And that gives me some nice targets to aim for. Once you've got these numbers, it's time for the ultimate question. How in the world can you make these numbers a reality? And that's where budgeting comes in. If you can't currently invest that much money right this moment, then that's okay. The important thing is to just get started, even if it feels like a really measly amount at first. Next, you want to try and find ways that you can decrease your spending while increasing your income. After all, those are the only two variables that we can play with to really grow our overall investment contribution. And if you're young, like me, then you probably want to focus on spending your time increasing your income, as that's going to pay the biggest dividends. Now, with that being said, let's go back to the whiteboard and put all this together. Now, my plan is pretty simple. I want to continue to grow my business, mapped out money, take the profits from this business and invest it into these different assets according to the spreadsheet that I just showed you, and then make adjustments every quarter. If you go through and forecast out, just like what I showed you in the spreadsheet, you'll pretty quickly realize whether or not your goals are possible and if you're on track. Or if you're nowhere close to your goals, and you either need to right-size your expectations or find a way to drastically increase your investments. This is exactly why I use this method. Now, I know my life isn't gonna work out as cleanly as the spreadsheet and the plan that I showed you in this video. I have a meeting with myself to revisit my spreadsheet, update the numbers, see where I'm at, see if I'm on track, and make some adjustments. I do this every quarter because ultimately things will change. Now, if you want to build this out for yourself, use the link below to download a copy of my spreadsheet. Also hit the subscribe button to follow along with my own journey towards 5 million. And if you're curious about how to make extra money right now, you'll want to watch this video next. If you have any questions at all about my calculations, I would love for you to leave a comment down below, and I'll see you next week.